Hey managerial accounting students, today we're talking about chapter 13, capital budgeting decisions. So when we say capital budgeting, we're talking about making big decisions on how to spend large amounts of money, like plant expansion, buying new equipment, replacing equipment. Should we lease or buy equipment or buildings or vehicles? And even looking at cost reductions, but we're talking about big decisions, big assets, big money. So in doing that, our capital budgeting usually falls into two big categories. One, first we do screening decisions. So does a proposed project meet some preset standard of acceptance? And then secondly, we'll look at preference decisions where we select from among several competing courses of action. Sometimes we use screening decisions to even advance a project to a preference decision. So as we make these decisions, we look at cash flows versus operating income. We'll be looking at the payback method, net present value, and internal rate of return. These methods are going to focus on analyzing the cash flows associated with capital investment in projects. So not necessarily our accounting net operating income, but looking at money in and money out. So the simple rate of return method that we'll cover briefly focuses on our incremental net operating income. But for the most part, what we're looking at in this chapter is going to revolve around cash flows. So typical cash outflows that we might see could include those for repairs and maintenance, any incremental operating costs, the initial investment, and working capital. We need to talk a little bit about working capital, but let's first talk about our cash inflows. Typical cash inflows might include the salvage value of any old equipment that we're disposing of, incremental revenues, of course, reduction of costs can be treated as a cash inflow, and then the release of working capital. But what's this mysterious working capital? In your textbook, it explains a little bit more about working capital. It says working capital is current assets like cash, accounts receivable, and inventory, less current liabilities. Well, but what does that have to do with our cash inflows and outflows? Why are we including that? Well, here's the idea. When a company takes on a new project, the balances in the current asset accounts often increase. So for example, if Nordstrom is going to open a new store, they're going to require additional cash in the sales registers, and they're going to need to have more inventory. So that's going to tie up working capital. These additional working capital needs are treated as part of the initial investment in the project. So then the other thing to be aware of down here, when the project is over, that working capital would then be released. So we no longer need to hold that extra inventory or cash in the registers. It would then be released. So to the extent that you have a cash outflow at the beginning of a project for working capital, make sure that you include a cash inflow at the end of the project when that working capital would then be released. So the other major factor that we need to consider in this chapter is the time value of money. I'm sure you've heard some of this before. $1 today is worth more than $1 a year from now, meaning that the buying power of that dollar today is worth more than a year from now. So let's say that I owe you $10. So I say, well, I could pay you back the $10 now, or I could pay you back a year from now. It doesn't matter to me. Well, wouldn't you want your money sooner rather than later? You're probably going to say, no, I want it now, maybe because you're worried I won't pay you back. But secondly, because there's power in having that money today rather than a year from now. And if you think about it, if we think really long term, what a dollar can buy today is more powerful than what it can buy a year from now. But go back in time. Ask your grandparents what they bought their first house for or their first car for. Clearly, the value of a dollar changes over time. And so that's what we have to factor in here. So they tell us, therefore, projects that promise earlier returns are preferable to those that promise later returns. So if you have a project that's going to return $100,000 to you next year, or there's another project that you're considering and it'll return $100,000 to you, but that's 5 years out, well, the one that returns the amount sooner is better. but we do have to do some computations for that time value of money. So the capital budgeting techniques that best recognize the time value of money are those that involve discounted cash flows. And we're going to learn how to do our computations where we bring future dollars back to today's dollars using time value of money tables. So the first method we're going to look at is the payback period. And the payback method focuses on that payback period, which is the length of time that it takes for a project to recoup its initial cost, so to recuperate the initial cash outflow. So here's the idea. The payback method analyzes cash flows. However, it does not consider time value of money. The annual net cash inflow is the same each year. Then we can use this formula to compute our payback period. So again, it has to have consistent cash inflows. So we take the investment required, so the initial outlay, and we divide that by our annual net cash inflow, and that equals our payback period. So, for example, management at the Daily Grind wants to install an espresso bar in its restaurant. It costs $140,000 and has a 10-year life, and it will generate annual net cash inflows of $35,000. Management requires a payback period of 5 years or less on all investments. What's the payback period for the espresso bar? So we're going to take the investment required, $140,000. We're going to divide it by the annual net cash inflow. So $140,000 divided by $35,000 should look like this. And we come up with a payback period of 4 years. So according to the company's criterion, management would invest in the espresso bar because its payback period is less than 5 years. Now, that said, I would use payback period as a screening tool. I wouldn't use this necessarily as a preference decision-making tool. Here, it clears the hurdle of 5 years. The payback is only 4 years, but we might want to compare that to other projects that we're considering. How about this one? Consider the following two investments. We've got Project X and Project Y. They both take an initial investment of $100,000, and then they have their cash inflows in each of the next few years. So year one cash flow, $60,000 for both. Year two, $40,000 for Project X and $35,000 for Project Y. And then year three cash inflow, nothing on Project X and $25,000 for Project Y. So which one has the shortest payback period? I'm hoping that you chose Project X, right? It gets paid back in exactly 2 years. Now Project Y is really close, but Project Y has a payback period of slightly more than 2 years. But which project do you really think is better? So Project X has a faster payback, but really Project X doesn't make us any money. In fact, if we want to factor in the time value of money, we're probably losing money on Project X. We put in $100,000 and we get back $100,000, but over the course of the next 2 years. Where Project Y, the money comes back a little bit slower, but ultimately we're making more money back than what we put in. So I'd say Project Y is probably better. So when we talk about the payback method, a couple shortcomings here. First, it ignores the time value of money. Secondly, it ignores any cash flows after the payback period. And then finally, shorter payback period does not always mean a more desirable investment, which we just learned in comparing Project X and Project Y. However, it definitely has its strengths. It can serve as a screening tool up front. So if we require that a project have a payback period of less than 5 years, then we can quickly screen through investment opportunities and decide if they meet that criteria. It identifies investments that can recoup cash investments quickly, or identify products that recoup initial investment quickly. That's the same idea. What about payback when we have uneven cash flows? When the cash flows associated with an investment project change from year to year, the payback formula that we used previously can't be used. Instead, we just have to track it year by year. So our example here, if a project requires an initial investment of $4,000 and provides uneven net cash flows in years 1 through 5 as shown, the investment is fully recovered in year 4. And we only know that from just keeping a running total. Okay, there's no formula for it. So we put in 4,000. In year 1, we get 1,000 back. So there's 1. Nothing in year 2. In year 3, we get 2,000 more back. So that's 2. We're at 3,000 that we've recouped. In year 4, we recoup another 1,000. So at the end of year 4, we fully recovered our $4,000. And then in year 5, we actually make 500 beyond that. So really, we're just counting and adding up what we've recuperated. So next, we're going to look at evaluating projects using the net present value method. Okay, so net present value. So here we're going to start getting into the time value of money and discounting our cash flows. So net present value, or NPV, because I know how you love acronyms, NPV compares the present value of the project's cash inflows with the present value of the project's cash outflows, and the difference between those is what we call net present value, or NPV. Now, to do NPV calculations, we have to have a couple big assumptions, 2 simplifying assumptions that we have to make here. First, all cash flows other than the initial investment occur at the end of the period. Now, we don't know if that's true or not. It could be, it may not be, but we can't do this day by day. So we have to pick a date, and it's always going to be the end of the period. All cash flows generated by investment project are immediately reinvested at a rate of return equal to the discount rate. That one's a little bit tricky. So I can accept that we have to pick a date, and we're going to pick the end of the period as our date. So that's the first assumption. But the second one, what they're saying is that any cash flow, any idle cash, any cash that we receive back would be immediately reinvested at the rate of return equal to the discount rate. That might be hard to actually accomplish, but again, we don't have any other way of doing this. So it's the assumption that we're given, and that's what we have to work with here. So we're going to learn NPV by walking through this example problem. Lester Company has been offered a 5-year contract to provide component parts for a large manufacturer. So we're going to need some special equipment, $160,000 worth to be exact. It's going to tie up $100,000 of working capital. In 3 years, we're going to have to reline the equipment for $30,000. The salvage value of the equipment at the end of the 5-year contract, we estimate to be $5,000. So during this period, though, it's going to provide annual cash revenue and costs. So we're going to have sales revenue from the parts. Cost of parts sold is going to be $400,000 though, and then we have to deal with salaries, shipping, and other expenses for $270,000. So really, if we look at $750,000 minus, we've got expenses totaling $670,000. So we're going to make some money each year, right? $750,000 minus $670,000, what does that equal? $80,000, right? So making $80,000 a year for 5 years, do you think that outweighs these costs up here, these big outlays of cash? We're going to have to factor in time value of money to really get our brains around that better. Some more information. At the end of 5 years, the working capital will be released and be used elsewhere by Lester, and Lester Company uses a discount rate of 11% should the contract be accepted. So our quick math, we came up with $80,000 of net cash inflows per year, but then we need to consider how that works with the time value of money. So here's the thing, on these NPV problems, the first thing you need to get used to is laying out the problem correctly. And I encourage you to take time, write it out on a piece of paper or make columns in Excel, whatever makes you happy. But you need to have a description of the item. You need to have a column for years, cash flows, factor, and present value. So when we say factor, that's what we expect our return to be. So we're looking at an 11% return. So here what they're saying is that our investment in equipment, that happens now. That's $160,000 outflow. Now it happens now, and therefore our factor is 1. In a few moments, we'll deal with what happens when it's not now, and we'll figure out how to get that factor. But if it happens now, the factor is 1. So meaning it happens immediately, we don't have to discount our cash flows back to today's value because it happens today. So the present value of that $160,000 outflow is the same, $160,000. It also ties up $100,000 of working capital now, and therefore the factor is 1, and we don't have to discount it back. It's just a $100,000 outflow. But what about the rest of it? Let's keep going. So we've got these annual net cash inflows. So we're going to make $80,000 of cash inflow for each of the next 5 years, years 1, 2, 3, 4, 5. So we need to go find the factor for that on our present value of an annuity of 1 table. So hold on one second. Let me flip a few pages here. So I'm in Appendix 13B of your textbook. I'm looking at the ebook, page 677 to be exact. And there's 2 tables back here. One is present value of $1. So that takes the dollar and discounts it back to today. And when we use this table, it's something that happens only 1 time. Then if you go down to the next page though, there's another table that is present value of an annuity of 1 in arrears, meaning at year end. This is the table we're going to use for this particular situation. And when they say present value of an annuity of 1, that means that it's repeating. It's happening each year. So an annuity comes from the root word in there is annual, right? Annuity. So it means it repeats every year. So in this case, we have $80,000 of cash inflow every year for 5 years. So rather than adding up what that would be here, if we look at year 1, year 2, year 3, year 4, year 5, and handling each of those years separately, the second table, present value of an annuity, adds it up. So when we have steady cash flows year after year, whether it's inflows or outflows, we can use the annuity table. So in this case, we're looking for 5 years and 11%, and we should find 3.696. Do you all see that? You'll need to get good at doing this on your own. So let's go back to our problem. So that's where they're getting 3.696. Okay, so that's not just a made-up number. You have to go to the PV tables in your textbook. Okay, so this one repeats year after year, so we're using the annuity table. And what you'll see on the annuity table is the numbers are above 1. If you go to the present value of $1 tables, the numbers are less than 1. So we're going to take 80,000, and rather than just multiplying it by 5 years, that would be awesome. That's 400,000. Well, it's not worth that much in today's dollars. We have to discount it back. So 80,000 times 3.696, that $400,000 discounted back to today's dollars is $295,680. We keep going. We have to reline the equipment in 3 years. So that's a $30,000 outflow. And now again, we've got to go back to the tables to find out our factor. So this is something that happens 1 time. It's not repeating, it just happens once. So which table should we use? I hope you said the first table, the present value of 1. So it happens 1 time, so we use the first table, and it was going to be in year 3. And we go to 11%, and we get 0.731. So that's what they're getting, 0.731. So that $30,000 in today's dollars is only $21,930. We keep going. Salvage value of equipment. So at the end of the project, that expensive equipment that we bought up front, we're going to get rid of it. And we think it's going to have a salvage value of $5,000. So again, we go back to the tables. This is something that happens 1 time, not repeating year after year, just 1 time. So at the end of year 5, we go row 5, 11% column, we get 0.593. So we take 5,000 times 0.593, and in today's dollars, that's $2,965. Also at the end of year 5, we're going to release the working capital. So year 5, it happens 1 time. So again, it's the same thing, 0.593. We don't have to look it up again. So in today's dollars, that $100,000 of working capital. When it gets released 5 years from now, that'll really feel like $59,300. So $59,300. So then we add all of that stuff up and we get a present value of $76,015. And based on this, we should accept the contract because the project has a positive net present value. What that means, to the extent that a project has a positive net present value, that is not a guarantee of any certain amount of cash that we're going to make. It doesn't promise anything other than it has a positive net present value. It's already factored in the requirement that we need to make 11%. So we're going to make 11% and then some. If our NPV is 0, that means that the project in this case would make 11% because that's our discount factor. A company can choose whatever discount factor they deem appropriate. So if the net present value comes out to 0, that just means that the project is going to yield the discount factor. If it comes out positive, that means it's going to make more than the discount factor, so more than 11% in this case. If the net present value comes out negative, it doesn't mean that the project is a total loser and we're going to lose money on it. It means that it's going to make less than the discount rate. So when we interpret what NPV means, we need to be careful not to take it too literally. So it doesn't mean we're going to make $76,000 on the project. It just simply means that we're going to make more than 11%. So let's try this one. Quick check. Denny Associates has been offered a 4-year contract to supply the computing requirements for a local bank. The cost of the computer equipment would be $250,000. It's going to tie up $20,000 of working capital. In 2 years, we're going to have to upgrade that equipment for $90,000. The salvage value of the equipment at the end of the project in 4 years should be $10,000, and it's going to result in annual net cash inflows of $120,000. And then the working capital will be released at the end of the contract, and Denny Associates requires a 14% return. What's the NPV? Now, let me go back. I want you guys to work this on a piece of paper, but this is your format. Obviously, this isn't the right data, but take a moment to get this format down in terms of description and then years, cash flows, your factor, which will be 14%, and present value. So get these column headings written down and then give this problem a try. You can go ahead and pause the video while you work on it. It's kind of a lot of work. I'm hoping maybe you came up with one of these answers. Did any of these numbers look familiar to you? Hopefully you came up with B. Does your work look like this? So the $250,000 investment happens now, so we don't need a discount factor, it's just 1. It's in today's dollars already. Working capital also needed now, $20,000. Again, the discount factor is 1. We don't have to discount it back. It's $20,000 today. And then we have our annual net cash inflows, $120,000 a year for 4 years. So rather than compute them each separately, which I guess we could do, but it's something that repeats year after year. So we want to use the second table. So in our textbook, we want to use present value of an annuity of 1. So something that happens for 4 years at 14%, we should come up with 2.914. So that should be our discount factor. 2.914 times 120,000, so that's 349,680 discounted back to today's dollars. We're going to have to upgrade the equipment 2 years out, so that's a $90,000 outflow. And again, we go back to our tables. This one's something that happens just one time, right? What year was that? Year 2. And 14%, we get 0.769. So we take 90,000 times 0.769. So in today's dollars, that's worth $69,210. At the end of the project, we can get rid of the equipment, and we think the salvage value will be $10,000. And the working capital is also going to be released at the end of the project, and that 20,000 that we put in now will be released. So we need to get our factor for that. So again, that's something that happens one time. So we go to year 4, 14%, I see 0.592. So that's where we're getting those factors from. We multiply, we add it all up, and we should come up with 28,230. I'm hoping you came up with that same answer. So here we're going to look at another way of computing our NPV. This data should all seem pretty familiar to you. So same thing, Lester Company, 5-year contract, special equipment, reline the equipment, and so on. So discount rate of 11%. Should we do this? So in this one, I know it starts out looking the same, so we look at now, but what we're going to see is just a different way of laying it out. So rather than dealing with the annuity and just looking at each item, this method has us focus in on years. So we do now, and then 1, 2, 3, 4, 5. So the 80,000 happens every year, but they're netting together what happens. So in year 3, for example, there's the 80,000 inflow, but then we had to pay out 30,000, I think, to reline the equipment. So they're just looking at what happens year by year rather than looking at what each of the items was. So ultimately, it should come out the same way. To me, this seems like more work. That 80,000 was easily computed when we dealt with it as an annuity, but they're just looking at it in a timeline sort of way rather than looking at each of the items. So mathematically, it should work out the same. Year 3, for example, that was the 80,000 inflow minus the 30,000 outflow, so the net cash flow is 50,000. And we come back to that same number that we previously computed for Lester, 76,015. So same idea, just a little bit different layout. I prefer the first way, but if it makes more sense to you to do it this way, by all means, do whichever way you're more comfortable with. So as we talked about before, when we interpret net present value, a positive NPV indicates that the project's return exceeds the discount rate. A negative NPV indicates that the project's return is less than the discount rate. And what they're not saying in there is an NPV of 0, this table shows it better. If it's 0, it's still acceptable because it promises a return equal to the required rate of return. So 0 is still perfectly okay because it meets that required rate of return. It doesn't mean that the project isn't going to make any money. It means that it satisfies that rate of return. So where does this discount rate come from? So the company's cost of capital is usually regarded as the minimum required rate of return. And the cost of capital is the average return the company has to pay to its long-term creditors and stockholders. So how much does it cost the company to acquire financing, long-term financing from lenders or from stockholders? There's a cost to doing that, whether it's interest or having to pay out dividends, there's a cost of that. So they would want to know what their cost of capital is, and that would be our minimum required rate of return. The Npv method automatically is providing for a return of the original investment. So again, that's why if it comes out to 0, that's totally fine. That means that it's returning the original investment and providing a return equal to that of the discount rate. Let's take a look at this one. Carver Hospital is considering buying an attachment for its x-ray machine. The cost is $3,169, 4-year life, 0 salvage value, and they think it's going to increase the annual cash inflows by $1,000. So just real quick, if we have 4-year life, $1,000, that's $4,000, but we need to consider the time value of money. No investments are to be made unless they have an annual return of at least 10%. Will we be allowed to invest in the attachment? So how do we do this? So we have our initial investment now, $3,169, and that's now. So our factor is just 1, and it's $3,169 outflow. Then we have our cash inflows each year for 4 years. Now, they went to the present value of 1, and they treated it like it was only happening one time. So let me go over to the textbook. I mean, we can do it that way. It's just not a good use of our time. So in the 10% column, and they're looking at 4 years. So year 1 was 0.909, 0.826, 0.751, and 0.683. Can you add those up for me? Okay, so if I add them up, I'm adding 0.909, 0.826, 0.751, 0.683. I could do them all separately, but if I add those up, I get 3.169. Okay, so this is from the first table, present value of $1. So this is things that happen one time. Why wouldn't we just go to the second table, present value of an annuity? It's got even cash flows for all 4 years. So why don't we go to row 4, 10%, and we get 3.17. When I added it, I got 3.169. Isn't that close enough? I'd say so. So anyhow, whether you want to do it their way, which is longer, or my way, which is shorter, what we come up with is the NPV is essentially 0. It's $1 or it's 0. It's about the same. So what does that mean? It implies that the cash inflows are sufficient to recover the $3,169 initial investment and to provide exactly a 10% return on the investment. Really no more, no less. So this satisfies what the requirements were. It provides a 10% return on the investment. Let's look at a different method. This is what we call the internal rate of return, or for short, IRR. So the internal rate of return is the rate of return promised by an investment project over its useful life, and we compute that by finding the discount rate that will cause the NPV to be 0. It works well if a project's cash flows are identical every year. So what are they saying there? Well, it works well if the cash flows are identical. It does not work well at all if they're not identical. So if the annual cash flows are not identical, a trial and error process must be used to find the internal rate of return. Essentially, we're talking about guess and check method. So it's a great method if we have identical cash flows every year. Other than that, it's not all that useful. So when we interpret IRR, if it's equal or greater than the minimum required rate of return, then it's acceptable. If it comes out less than the minimum required rate of return, then we should reject that. And when we use the internal rate of return, the cost of capital essentially is acting as a hurdle rate that a project must clear for acceptance. So again, this might be a good screening tool to see if a potential investment, a potential project meets that required rate of return. So our example, Decker Company can purchase a new machine at a cost of $104,320 that will save $20,000 per year in cash operating costs. The machine has a 10-year life. So for IRR, our future cash flows are the same every year in this example, so we can compute it this way. We take our investment required, so that's the $104,320, and then we divide it by our annual net cash flows, $20,000 a year, and we come up with 5.216. What in the world does that mean? Well, that's our present value factor for the internal rate of return. So we need to take that 5.216, and then we got to go to our tables. So here they're showing us a little excerpt from the tables. Find the 10-period row, so we're looking for row 10, and move across until you find the factor 5.216, or something at least close to that. And then look at the top of that column, and it's 14%. So we're essentially backing into that rate by going to row 10 and finding whatever came out closest to our PV factor. In this case, they carefully did the math here, and we came up with 5.216 exactly, which is 14%. 10 years, 14%. So if Decker's minimum required rate of return is equal to or greater than 14%, then the machine should be purchased. Think about that for a minute. Is that right? If the minimum required rate of return is equal to or greater than 14%, then the machine should be purchased. How about there? That makes more sense. If the minimum required rate of return is equal to or less than 14%, so our minimum required return is 14% or less, and this project yields 14%, then we should purchase it. If our minimum required return, though, is more than 14%, so we have a required rate of return of 16%, well, this project only yields 14%, and therefore we're not going to want to do it. I hope your textbook has this right. That was an error in the slide. So if it's equal to or less than 14%. All right, you try this one. You've got your pencil, calculator, your present value tables. So the expected annual net cash inflow from a project is $22,000 over the next 5 years. The required investment now in the project is $79,310. What is the IRR on the project? So we take that initial investment and we divide it up by the annual net cash flows. And you should come up with a factor. What did you get? Hopefully you got 3.605. And then we're going to go to our PV tables. So we're looking for our PV tables, and let's see, it was 5 years. So we go to row 5 and we're looking for something close to 3.605. Ah, there it is. So our internal rate of return then would be 12%. So that's B. Does that make sense? You definitely need to have those PV tables at hand though. So make sure you have your ebook open. So comparing NPV and IRR. Already I want to argue with this. NPV is often simpler to use. Wait, what? I don't remember NPV being simpler to use. Do you remember some of these NPV problems that we did? You're telling me that this whole thing was simpler than doing this quick problem down here that we just did as a quick check? I don't think that was simpler at all. NPV is a lot of work. So I'm not going to jump on that bandwagon. NPV is more difficult to use. Questionable assumption. The internal rate of return method assumes cash inflows are reinvested at the internal rate of return. Well, to be honest, we made a similar assumption with NPV, that all of our cash flows were going to be reinvested at the discount rate. Also could be problematic. So if the internal rate of return is high, this assumption may be unrealistic. It's more realistic to assume that cash flows can be reinvested at the discount rate, which is the underlying assumption of the NPV method. Both methods are making this big assumption, but the rates might be more realistic in NPV versus IRR. So they both have some flaws, but they both do play an important role in terms of helping us with our decision-making process. No, they're not perfect, but remember in managerial accounting, we focus less on precision and more on the timeliness and relevance, that we have data that we can use to make a decision. And while it may be imperfect, it's better to base our decision-making on numbers than not at all. So we're going to keep going a little bit more with the NPV method to consider 2 different alternatives. So we're going to analyze alternatives using what's called the total cost approach. So all cash inflows and all cash outflows will be included in the solution under each alternative. No effort will be made to isolate those cash flows that are relevant to the decision and those that are irrelevant. So maybe things that don't differ between the alternatives. And the NPV will be computed for each alternative. So total cost approach, our example here, White Company has 2 alternatives. They're going to remodel an old car wash, or they're going to remove the old car wash entirely and install a whole new one. So they have a discount rate of 10%, and they've laid out the 2 alternatives here. So if we're going to get a new car wash, we'll have annual revenues of $90,000, operating costs of $30,000, and therefore net cash flows of $60,000. If we're going to remodel the old car wash, we think our revenues will be $70,000, the operating costs will be $25,000, and therefore annual net cash inflows of $45,000. So we'll have less annual net cash inflows if we remodel the old car wash, but I imagine there's going to be a cost to buying this new car wash entirely. So if we install the new washer, the cost is $300,000. We think it has a productive life of 10 years, salvage value of $7,000. We're going to replace the brushes at the end of year 6, so that's $50,000, and the salvage of the old equipment now is $40,000. So there's two different salvages here. This first salvage, the $7,000, is what our new washer would be worth at the end of 10 years of use. This one, the salvage of the old equipment, is if we remove the old car wash today and install the new one, we think that old car wash today could salvage for $40,000. So that's why there's two different salvages. We're getting rid of the old one, we're buying a new one, and at the end of the new washer's life, there's also that second salvage. So laying this all out in NPV manner, so we list each item, we list the year, the cash flow, the factor, and our NPV. So the initial investment happens now, so that's minus $300,000. 6 years from now, we have to replace the brushes, so $50,000 outflow, but we go to our PV table, so just PV of 1, it happens only one time. So we go to row 6, 10% column, we get 0.564, so that's $28,200. Then we have our annual net cash inflows. So they put year 1 through 10 all together. So this is an annuity. It happens each year for 10 years. So we go to the second table, PV of an annuity of 1, and we go to row 10, 10% column, and we should find 6.145. So the value of $60,000 a year for 10 years, discounted back to today's dollars, is $368,700. We're going to salvage that old equipment now, so that's $40,000, and then we're going to salvage the new equipment at the end of year 10, $7,000, and our factor, we go to row 10, 10%, on the PV of a dollar table, so the first table, because it happens one time, and that's worth $27,02. So we add all of that up, and we have a big positive $83,202. So what that means is that installing the new washer exceeds the 10% discount rate. So it seems like it's an acceptable project in that regard, but we want to compare it to the other option. So if we install the new washer, the investment will yield a positive NPV of $83,202. On the other hand, if we remodel the existing washer, we're going to have to pay $175,000 in remodeling costs, and we're going to have to replace the brushes at the end of year 6. So again, we lay it all out using our same format again, $175,000 now, $80,000 at the end of year 6. So you're going to PV of a dollar, the first table, row 6, 10% column, we get 0.564. So that's worth $45,120. And then we do our annual net cash inflows. And again, this is something that repeats year after year. So we're using PV of an annuity. So the second table, and we go to row 10, 10% column at 6.145. So we add all that up, we get $56,405. So if we remodel the existing washer, we will produce a positive NPV of $56,405. So they both yield a positive NPV, but if we just compare them head to head this way, it looks like investing in the new washer is more favorable than remodeling the existing washer. But I do think we need to add in that they require different amounts of initial investments. We'll look at that toward the end of the lecture in terms of considering these projects with different amount of investments. So yeah, the NPV is greater when we invest in the new washer versus remodel the old washer, but remember, remodeling the old washer was going to cost us $175,000 now and $80,000 a couple years, 6 years out. Where buying a new washer is $300,000 now and $50,000 6 years out. That's a lot more. If we're putting a lot more money into the project, wouldn't we expect the return to be greater? Maybe. We're going to have to look at another way to analyze that. But for now, we're in favor of the new washer. How about decisions where we don't have revenue. Maybe we're just trying to minimize our costs. So we're looking at the least total cost from a present value perspective. So here we have Home Furniture Company. They're trying to decide whether to overhaul an old delivery truck now or purchase a new one. The company uses a discount rate of 10%. So here's our facts. We've got the old truck. We could overhaul it now for $4,500. It costs $10,000 a year to operate. We think in 5 years the salvage value will be $250, but we think the salvage value now would be $9,000. And if we buy a new truck, the purchase price of the new truck would be $21,000. It'll cost $6,000 a year to operate, and 5 years out, we think it'll have a salvage value of $3,000. So think about this. The old truck, if we salvage it now, it's worth $9,000. You can almost look at that as a trade-in against the $21,000 new truck, right? You're only going to salvage the old truck now if you're going to buy the new truck. So really, already I'm leaning toward buying the new truck just based on that. But we need to do the math and use NPV to do it properly. So if we buy the new truck, it's $21,000 now. So the PV factor is 1 because it's now. Our annual operating cost, we treat that as an annuity, so an outflow of $6,000 a year for 5 years. We go to the second table, PV of an annuity, go to row 5, 10% column, and we get 3.791. Salvage value of the old truck, now $9,000. That's huge. Really, if we offset that against the $21,000 outflow up front, seems like a pretty good deal. So 9,000 now is 9,000, and then our salvage value of the new truck at the end of year 5, we can salvage it, we think for 3,000, which again we have to discount back to today's dollars, so this happens one time. So we go to the first table, row 5, 10% column is 0.621, so that's worth $1,863 in today's dollars. So we add all that up, we've got negative $32,883. Now, of course it's negative. We're just making a least cost decision. There is no revenue involved here. Then we look at keeping the old truck. We can overhaul it now for $4,500. So that's now, so it's just $4,500. Our annual operating cost, we're taking $10,000 a year. We treat it as an annuity for 5 years. So our factor is 3.791. So that costs $37,910 in today's dollars. And then the salvage value at the end of year 5, we take the $250 times 0.621 factor, $155. So we add all that up and we get an NPV of negative $42,255. So based on this, we should be in favor of buying the new truck, which to me sounds like a good deal. But what if you don't have cash on hand to buy a new truck? $21,000 minus 9, we have to have $12,000 to buy the new truck now. If you don't have $12,000, then that's off the table. So then overhauling the old truck looks good for only $4,500. So comparing it, the NPV in favor of purchasing the new truck would be $9,372. So next we're going to evaluate an investment project that has uncertain cash flows. That can be kind of tricky. Our example here, quite honestly, I find to be a bit bizarre, but just roll with me for a minute. Assume that all of the cash flows related to an investment in a super tanker have been estimated, except for its salvage value in 20 years. Well, first of all, the likelihood that we have, we're talking big dollars here, and they've estimated everything, but they can't seem to come up with the salvage value. I don't know. Something strange about this problem. They're using a discount rate of 12%. Management has determined that the NPV of all the cash flows, except for the salvage value, is negative $1.04 million. Okay, so again, management's able to figure out all these numbers and come up with the NPV, but they can't seem to come up with the salvage value. I don't know. Anyhow, mathematically, they want to know how large would the salvage value need to be to make this investment attractive. So we're going to take the net present value that we need to offset, $1,040,000, and we're going to divide it by the PV factor. Where did we get that? We're going to go to PV of 1, so the first table, we're going to go to row 20, 12% column. So row 20, 12% column. Can you even see that? It's way up there. So row 20, 12% column is 0.104. So that's where that's coming from. So we divide 1,040,000 by 0.104 and we get $10 million. So what that means is that the salvage value of the super tanker would have to be at least $10 million to offset the net present value, to zero out the NPV problem is what they're saying. Their scenario here seems kind of absurd to me, but the point is that you can back into a missing piece in an NPV problem to find out, well, how large would this need to be? How much would we need to make on this in order for this to make sense for our company? So I don't love this example, but the quick check here makes a little more sense. Bay Architects is considering a drafting machine that would cost $100,000, last for 4 years, and provide annual cash savings of $10,000 and considerable intangible benefits each year. How large in cash terms would the intangible benefits have to be per year to justify investing in the machine if the discount rate is 14%? Now, some of that might seem kind of strange, but what I'm picturing is this professional office where they have this machine that is extremely frustrating, and they want to buy a new machine, a new drafting machine, because the old one is really frustrating and it's causing problems in the office, anger, frustration, wasted time, work output that's useless. So they want this new drafting machine. In my mind, I'm picturing in office space when the guys take the printer out to the field and beat it with baseball bats. So they want to know, how large would those intangible benefits have to be per year to justify investing in the machine? So how will we do that? We need to lay it out in NPV format. So we'll have our years, $100,000 outflow now, and then we'll have our annual net cash inflows, $10,000 a year for 4 years. So that's an annuity. You need to come up with your factor for that. So row 4, 14% column. And then we have these unknown intangible benefits. Now, first of all, your answer choices are kind of funny. All of them are nice round numbers except for one, which maybe tells us something. I'm hoping you chose that answer. C, 24,317. And here's how it works. So we've got the 100,000 outflow. The annual net cash inflows should come out to 29,140. So 10,000 times our factor of 2.914, 29,140. And all of that comes out to negative 70,860. So what does that mean? Well, to make this zero, then this number has to be 70,860. We divide it by 2.914 and we get 24,317. And again, that's annual intangible benefits, so that would be each year. Now, keep in mind that intangible benefits don't have an actual dollar amount, but they're saying that if we had to put it into dollars, the intangible benefits that we're experiencing from this new drafting machine need to be about $24,000 a year to make this investment worth it. So management will have to decide if they think it's worth $24,317 worth of happiness per year. So next we need to look at ranking our investment projects in order of preference. So we've been through a lot of different decision-making tools here, some of them being screening decisions, others being preference decisions. So the screening decisions pertain to whether or not some proposed investment is acceptable. Does it meet some hurdle rate? And then preference decisions are ones that attempt to rank acceptable alternatives from the most to least appealing. So IRR, internal rate of return, we use IRR to rank competing investment projects. The preference rule is simply the higher the internal rate of return, the more desirable the project. If we're using NPV, this is tricky. The NPV of one project cannot be directly compared to the NPV of another project unless the investments are equal. Now, that's what I was alluding to back when we were looking at White Company and the car wash and whether they should uh, remodel the old car wash or buy a whole new one. And I could say the same of the company that wanted to buy a new truck. Different amounts of investment. So we shouldn't necessarily compare them head to head. So what they're going to have us do is rank those investment projects. So we take the NPV of the project and we divide it by the investment required. So here they made our numbers real easy. Both of these projects, Project A and Project B, have an NPV of $1,000, but they have different investments required. So the investment required for Project A is $10,000 and it yields an NPV of $1,000, while Project B takes an investment of $5,000 and yields an NPV of $1,000. Now, I don't have to do math to be able to see that Project B is better. It requires half the amount of investment and yields the same NPV, but it's not always that obvious, and the net present value isn't always the same. The key is that they have different amounts of investment required, and therefore we want to turn it into a profitability index, dividing A by B. So the higher the profitability index, the more desirable the project. So Project B is more desirable than Project A. So NPV is a very useful tool, but we need to be careful in terms of ranking our investment projects. Simple rate of return. So this is a different method, different from the others in that it does not focus on cash flows, but rather on our net operating income. So more of an traditional accounting focus rather than our focus on cash flows and discounted cash flows. So our formula for simple rate of return, we take the annual incremental net operating income, and then we divide that by the initial investment. And they put a little asterisk there. That should be reduced by any salvage from the sale of old equipment. So we're going to offset the initial investment with any salvage from the sale of old equipment up front. So back at the daily grind, management wants to install an espresso bar in the restaurant. It costs $140,000, 10-year life. It's going to generate incremental revenues of $100,000 and incremental expenses of $65,000, which includes depreciation. Now, if we're talking about cash flows, we'd have to remove depreciation from this whole computation because there's no cash involved with that. But this one, we're looking at our incremental net operating income, and therefore that's okay. So if they want to know what's the simple rate of return, well, our annual incremental net operating income, 100,000 minus 65,000 would be 35,000, and we divide it by 140,000, our initial investment, and we should come up with 25%. So that's our simple rate of return. That's all there is to it. Now, it was easy to do, but there are a few shortcomings. First, it entirely ignores the time value of money, which, as we talked about, is an important concept in this chapter. This one kind of baffles me. The same project may appear desirable in some years and undesirable in other years. I'm not sure why that would be. Maybe if our simple rate of return is 25% and in one year we have a required minimum return of 30%, in another year a required minimum return of only 22%, then it might be desirable in some years versus the other. I would focus more that the real shortcoming is that it just entirely ignores the time value of money. When investment center managers are evaluated using ROI, a project's simple rate of return may motivate them to bypass investment opportunities that earn positive net present values. Oh boy. We're going back to that chapter where they were ripping on ROI and they had the voodoo dolls and the blood dripping darts and all of that. I don't know why they got to bring that up again. The simple rate of return, it's not a bad thing to use, but they're using it in conjunction with ROI, which the textbook authors already made very evident that they don't like ROI. And they're harping on the same reasoning that managers might bypass a good investment opportunity if the simple rate of return doesn't fall in the right range according to their required rate of return. So Anyhow, I'll let that go. Enough talking about that. Um, One last thing, a post-audit, and that sounds like a scary, complicated term. It's really just a follow-up after the project has been completed to see if the expected results were what we thought when we were making decisions up front. If we're using all these decision-making tools, screening tools, preference tools, it would be a great idea to follow up and see if a project actually yields what we thought it would yield, because that'll help us fine-tune our decision-making process in the future. So it's just that follow-up, looking back to see, did this project really turn out how we thought? So that's it. That's all of chapter 13. Definitely practice NPV, not to say to ignore the others, but practice NPV and working on how to lay out those problems in good format. That'll help you be able to crunch through the problems for this chapter. All right, you guys, let me know if you need any help. You know where to find me.